If you own a rental property, the next few weeks can make or break your 2025 tax return. The IRS gives landlord powerful deduction, but only if you meet the rules and act before December 31st. In this video, we are diving into exactly what every landlord should do before year-end to legally reduce taxable income and keep more rental profit. We'll walk through three essential parts. So part one, let's talk about depreciation accelerator. Part two, repairs and improvements. And part three, QBI safe harbor rules. Then we will wrap up with step-by-step year-end checklist and some bonus tips you can implement immediately. If you manage rental property, whether personally or through a property manager, this episode is for you. By the end, you will know exactly where to focus the final 2 months of 2025 to lock in every deduction available under the One Big Beautiful Tax Bill. Let's talk about part one, depreciation accelerator, your fastest route to landlord tax saving. So depreciation is the engine that powers most rental tax saving. It lets you recover the cost of your property over time, like 27.5 years for residential rental and 39 years for commercial. But for 2025, something special is back, the 100% bonus depreciation. Thanks to the One Big Beautiful Bill, you can now write off the entire cost of certain assets this year, as long as they are acquired after January 19, 2025 and placed in service by December 31st. This includes assets with a recovery period of 20 years or less. So 5 or 7 years personal properties like appliances, blinds, and carpeting. 15-year land improvements like driveways, fences, and landscaping. And qualified improvement property for non-residential interior improvements. However, roof, HVAC system, or other structural components of residential buildings are not eligible for bonus depreciation. They stay on the 27.5-year schedule. Now let's make this practical. The IRS requires that the property be placed in service, meaning it's installed, ready, and available for use before December 31st. Paying for it isn't enough. So let's look at the scenario. A couple, Morgan and Jamie, own a small rental duplex in Portland. In November, they placed all major appliances, installed new vinyl flooring, and upgraded the driveway with new concrete. Each project completed and ready for use before year-end. Because these items are classified as 5 and 15-year property and were acquired after the cutoff date, they claim 100% bonus depreciation on over $40,000 of upgrades. That single move nearly eliminated their taxable rental income for the year. Here's how to make this happen for yourself. Step 1, list out every improvement you are planning for the next 6 weeks. Step 2, identify which one qualify as short-lived property. Step 3, schedule installation now so they are completed by December 31st. Step 4, keep documentation. You want to have invoice marked installed with photo and sign up. Step 5, give your accountant the itemized list so the deduction get mapped correctly. So what if your rental was purchased years ago? You're not out of luck. That's where cost segregation come in. Cost segregation breaks the property into components with shorter depreciation lives, allowing you to accelerate write-up. On a $400,000 rental, it's common to reclassify $80,000 to $120,000 as short-lived properties. Even better, if your property was placed in service in a prior year, you can catch up missed deduction in 2025 by filing Form 3115 for a Section 481A adjustment. No amended return required. Imagine a scenario with someone named Taylor who owned a mid-sized apartment building purchased back in 2020. Taylor does a cost segregation study this year, identified $110,000 of 5 and 15-year assets, and elects full bonus depreciation on the newly added items. This one moved taxable income dramatically while boosting cash flow. So depreciation is not just a formality, it's a planning tool. So the next 2 months are the time to act. So let's move to repairs and improvements for our part two, where landlord win or lose deduction. Now we have tackle depreciation. Let's move to repairs versus improvement. This is the part that decide whether an expense hit your return this year or get locked into depreciation for decades. The IRS gives landlord three safe harbor to simplify this. First is the Minimis safe harbor. Second is the small taxpayer safe harbor. The third one is the routine and maintenance safe harbor. So let's start with the Minimis safe harbor. So if you adopt a written capitalization policy by December 1st, you can deduct item costing up to $2,500 each or $5,000 if you have an applicable financial statement. So this includes small appliances, individual fixtures, light replacement, and one-off plumbing repair. So here is your to-do. Write a policy now, apply it consistently, and keep every invoice below the threshold clearly documented. Now the small taxpayer safe harbor. So if your average annual receipt is under $10 million with your income and your property unadjusted basis is under $1 million, you can deduct the total of repair, maintenance, and improvement up to the lesser of 2% of basis or $10,000 per building. So here's an example for you. So Renee, who owns a 4-unit building with a basis of $850,000. So her 2% limit is $17,000. So 2% times the basis, which is the $850,000, so that gives her $17,000. So that is more than 10K, right? So which amount apply? Which one is the lesser, the 10K? So in November, she replaced the gutter, patches concrete stairs, update light fixture, and repaint hallways, all totaling $15,500. Because she meets the income and basic limit, she deducts every dollar this year under the small taxpayer safe harbor. If she didn't use the safe harbor, she would have to capitalize those improvements and recover them over years. How to implement it, right? So one, you want to calculate your property basis. Two, you want to apply the 2% or $10,000 cap. The three is the flat eligible expense. Four, you want to tell your CPA to attach safe harbor reduction to your return. Remember, your CPA, or when you do your tax return, you have to attach the election. You have to elect this election, or any election for it to be effective, right? And remember, major projects like a full roof replacement or HVAC overhaul are capital improvement. It's not repairs. But smaller items like patching, sealing, or restoring or function is usually qualified for immediate deduction. If you apply the safe harbors intentionally, you will gain flexibility to manage your taxable income each year. Now let's talk about QBI safe harbor. So you want to unlock the 20% deduction for a landlord. So this is going to be our part three. So far you have learned how to celebrate depreciation and spend more small repairs. Now let's tackle one of the most valuable yet overlooked benefits for landlords, which is the qualified business income deduction, or QBI. So when is it good to use QBI? QBI is to, especially when you have income. So usually when your depreciation is not enough and you have rental income, this is where QBI come in handy, right? But if you have a loss because of depreciation, and then QBI actually works kind of against you, because then your QBI loss you can, is a loss. So you're gonna have to carry it forward usually, or offset it with other businesses. So if you have other businesses that you have QBI deduction, so you think about it as like income that qualify for QBI, and your rental have losses that also apply to a QBI. So that lot offset your income, so your deduction is smaller, right? Because of the loss is offsetting. Or if you don't have QBI income this year, the loss is going to be carried forward and work against you in the future. So for rental, it's a special case because QBI deduction works for you when you have rental income. But if you don't have rental income and you have a loss, this is the majority of the rental owner wants to have loss, usually created by depreciation, then QBI actually works against you. So think of this and apply it, and then you want to talk with your tax pro to kind of model it out. But let's go to how it works. So like, let's just look at the basics, the mechanic of it, right? So the deduction can knock off 20% of your rental income, but only if you meet specific safe harbor rules. So here is what you need to do. So this is where if you have rental income, then this is what you want to look at to see if you qualify to do QBI deduction. So to qualify, right, for rental, you need to perform at least 250 hours of rental services per year, and then you need to have a log. So you need to maintain a contemporaneous log of those hours. You need to keep separate books for each rental enterprise, and you want to avoid triple net leases or personal use period, right? So rental service including like collecting rent, tenant screening, advertising, cleaning, maintenance, repair, and bookkeeping. And then those are good to qualify for your hour. However, the hour that fall under the investor activity, like reviewing financial statement or refinance, don't count for that 250 hours. Here, how this works in real life. So let's talk about Alex, who managed 3 long-term rental in Arizona. So throughout the year, Alex clocked 275 hours of rental activity. So that he's more than the 250 requirement. So he's 255 hours, responding to tenant, coordinating maintenance, doing bookkeeping, and handling turnover. So the property manager records show another 100 hours of routine maintenance and tenant communication. Together, that satisfies the safe harbor 250-hour requirement. So Alex now qualifies for the full 20% QBI deduction on the net rental income. So how would you implement it? So step one, decide if you are grouping your rental into one enterprise. If you do this, there's another election you have to check and when you do your tax return, right? Step two, you want to track all rental service hour in QBI Safe Harbor Tracker or a spreadsheet. Step three, you want to gather property management record or vendor invoices that show service hours. Step four, you want to maintain separate books by enterprise. Step five, you want to review leases for triple net term and adjust it if needed. So if you are in triple net and QBI is more, QBID is more beneficial for you, so maybe consider getting out of the triple net. It's your choice. Sometimes you just have to run the number to see it. Step six, if you are short on hours, you can plan extra qualified work in November, December, like annual inspection, tenant communication, and maintain tasks all count. So documentation is key. If you can't prove the hour, the deduction will disappear. So landlord year-end checklist, your 2-month sprint plan is gonna be the focus of our part 4. So now that you understand the 3 major areas before, let's turn this into a checklist to help guide you through the last stress of the year. So number 1, you want to finalize your capitalization policy for the Minimis safe harbor. Number 2, you want to review all expenses and classify repair versus improvements. Number 3, you want to schedule and complete installation for any bonus eligible assets by December 31st. Number 4, consider a cost separation study for property acquired or improved by 2025. Number 5, update and finalize your QBI time block. Number 6, reconcile your income and expenses for each property. Number 7, prepare your safe harbor election statement for your tax return. Number 8, backup documentation, photos, invoices, and place in service confirmations. So number 9, you want to collect W-9 for all vendors now to avoid delay for with 1099 in January. And number 10, prepare a depreciation schedule binder so future recapture calculations are easy and accurate. Here are some practical tips to maximize your 2025 tax outcome. So bonus tip number 1 is to focus on land improvements. So like driveway, parking, path, and fencing are all 15-year assets and bonus depreciate eligible for this year. Tip number 2, track mileage for any management trip or errands. So every mile relates to your rental count. Tip 3, keep material and supply separate from improvement so they can be expensed right away. Tip 4, if you have a short-term rental averaging under 7 days, confirm whether it qualifies for QBI or if it falls under active participation rule instead. Tip number 5, plan now for depreciation recapture if you're considering a sale in 2026. You can explore installment sales or 1031 exchange to manage that future tax. Here how a typical scenario play out when this planning is done right. So let's look at landlord Jordan who owned a triplex in Honolulu. So between November and December, Jordan replaces laundry room appliances, installed new fencing and exterior lights, and repaved the parking area, all placed in service before year end. A cost segregation study identified bonus eligible improvements and all QBI hours are logged and verified. So Jordan net taxable rental income for 2025 dropped to near zero, even though rental cash flow stayed strong. That's how smart planning turn a property into a tax efficient asset. So let's recap the roadmap for this one. So part 1, we talk about depreciation accelerator, plan and install bonus eligible assets before December 31st. Part 2, prepare versus improvement. Can use safe harbor to expand small repairs immediately. Part 3, QBI safe harbor, document 250 hours of services and qualify for the 20% deduction if you have rental income. If you have a loss, you might want to make sure you don't qualify for this. All of these strategies work together to help you legally lower your taxable income and maximize your return on investment. So as you wrap up 2025, take the time to install, document, and record everything before the year closes. And if you want templates and tracker that make it easy, you can visit prodeduction.etsy.com to grab the Landlord Year-End Pack and QBI Safe Harbor Tracker. For a step-by-step video walkthrough on this strategy, head over to accesswebinstitute.com and explore the Landlord Tax Planning Masterclass. Your properties are already earning income. Now make sure they are working for you during tax time.